So thank you for coming. Today's session is mastering the art of spotting reversal signals. So there is an art to spot the reversal. So reversal is very powerful, and I like reversal. So reversal is very powerful if you can spot, and not only you spot, but ability to make the decision quickly. So ability to make the decision quickly that this is the reversal you want to go for. So I give you an example. First, I give you example of a regular scenario, which is easy to spot. And then there is a scenario which is not easy, like today. So look at this scenario, and it's also called the complex cause and effect. So there are various cause and effect scenarios going on in the market, and traders don't realize it. There's a traders think of the linear cause. So there is, if the market is or if some, let's say if the war breaking out, then they just believe that the market will tank. So that's the way they think, linear cause. If the Tesla is running up, they just think the Tesla is running to the upside. There's no other reason why the Tesla is running. So here's the example of a complex cause and effect in Tesla. So just assume there is a trader named John. I have a friend named John. So John is actually everywhere. So if you are John, you are everywhere. You're very famous. If you just, I'm going off the topic. If you um, like, if you want to know who, I read books and they turn out to be written by some John or some philosopher John or some psychologist John or some expert John. There's so many experts and philosophers named John. So people say that if you want to, if you, so there's a study done. If you are a white male and you are tall, if you name your son John, he will be, most likely he will be successful and he will be tall and handsome. So John. So that's another example I'm just giving you. So just assume there is a Tesla on the run. It's a John trader. He actively trade Tesla. So he's in the market early morning. He see the Tesla spikes up. So he see the price is spiking up. Then he comes to know that the earning report came and Tesla beat the market expectation. So he has this news. Then he also see the market is bullish. So the market is bullish. He also comes to know overall the market is bullish, and he also figures out that, or he reads somewhere that the competitor of Tesla facing some regulatory challenges, and so it's affecting Tesla positively. So he gets this news. Then he comes to know that analysts upgrades Tesla. So major firms upgraded Tesla. So that's positive. So you see how many things are positive. The market is Tesla opening up, earning report positive, market sentiment positive, bullish trend, market is bullish, industry news favoring Tesla, analysts upgraded Tesla, trading volume above more than average. So all these factors combined, he puts a comprehensive analysis. He's quick in his thought process and he goes long on Tesla. So it works out and Tesla runs to the upside. So he is happy about Tesla or Nvidia, whatever, these big names. So this is a complex cause effect. So there are many causes and the effect is same. The effect is that the Tesla is moving up. So there are many causes, and the effect is one, that the Tesla is moving up, and he recognizes it, and he trades Tesla and profit of Tesla. So so this is his analysis. So when he analyzing Tesla, the inside he's going through this feeling or this process. So he see the signal. So the signal is coming to him through multiple complex causes. So all those causes I described to you, he see the signal and he recognized that it's familiar signal. So you see the signal he is recognizing, not only the chart, but all the news he just came to know about Tesla. the upgrade, the earning report, the positive news, negative news about the competitors of Tesla. So all that uh, he combine it, and when he looks at the chart, he sees it's moving up. So he combines it and creates one signal. So it's when people say, "Hey, send me the signal," so okay, send me the signal. Here's the signal. So I describe all. So comprehensive analysis of Tesla, see the signal, recognize that it's familiar. So based on his past experience, his competency, his skill, all that, the way he trades, he recognizes that it's familiar. So when he recognizes familiar, and he must get a positive feeling, a good feeling in his tummy. So that's one thing, the good feeling inside the tummy. So feel inside and see that you getting some good feeling about it. So when you feel good about it, then you need to be bold and courageous and take action, some kind of action. So take some kind of action, bold action. So what is complex cause and effect is very challenging to identify a single direct cause for an effect. So think about it. If we just see Tesla um, moving up and the volume is high, we just say, okay, the Tesla, there must be some positive news, and the Tesla is moving up. So there's only one single reason. No, there could be multiple reasons for the stock to move up or multiple reasons for the stock to go down. So the way you're thinking may not be, you're relating it to one single cause. There could be multiple causes, and the multiple causes are coming and deciding the action in the market. And the action in the market is something else. What you think is not there is something else. So many causes in an open system. So it's so many. So just think about it. This weekend, the war and all that, and when the market opened, the futures market were down. So in early morning, the traders must be thinking that, okay, all hell break loose, and I'm going to sell all my positions, and I'm buying puts and all that. So it turns out that this is the market moved up. So system thinking, what else is going on, how the other traders are reacting. So analyzing the lot of factors, not just the war broke out and then I'm going to short everything. So there's so many multiple interconnected factors coming together. And then the result is something else. So result is something else because there's so many interconnected factors in the whole world, not just something in the Middle East, um, so not good. So futile to think in terms of linear thinking. So if you just think that the war broke out and the market will tank, then is we are thinking in terms of linear. Whereas the big boys, they are not thinking in terms of linear thinking. They have a complex system. They have a lot of resources and they are thinking in a lot of other ways. So that's why they make a lot of money. And the retail traders just think linearly and lose money in the market. So, so war in the Middle East, so let's say war in the Middle East, news and events. So responding to news and events, whether positively or negatively. So what is going on, how the market is reacting, the initial reaction. Usually what I have seen based on my experience, if the news comes in the during the weekend, unless it's something very catastrophic. So news comes negative in during in the weekend, and the futures market tank overnight, and actually, by the time the market is opening, the futures market have already bottomed, and they are um, reversing. So if you have a basket of the stocks, like 10 or 12, you start with Amazon, Apple, Adobe, Meta, Google, Tesla, Nvidia, into all this, like 12 or 13 stocks. They out of those, if you really focus on them and screen out, screen out so a lot of oil stock, they today they just gapped up. So it's useless to trade the oil stocks. They just gapped up. I don't know, somebody is buying it, the big gap. So I looked at oil stock, and I said, oh no, that's too much gap. So I cannot trade oil. So the other basket of stock, there are 13 of them, which I gave you the name, 12 or 13. So look at those, which one are hitting the support level and about to reverse. So I'll show you some generic chart and explain to you how to recognize. So recognizing causal link between news and potential market event. So a lot of complex things are happening in the market, and you are putting 2 plus 2 together. So it's not easy. So let's take another example. I gave you the example of Tesla, and I gave you the example of, let's say, Meta. So war in Middle East. John also actively monitoring the development in the Middle East. So he loves Tesla. He's trading Tesla, and now he's watching the war in the Middle East. So he's turned on some CNN or MSNBC or Fox News, etc. And he said, okay, the big thing is happening in Middle East. The future market is in a downward move in pre-market. So he expect the price direction, the gap down, and all hell will break loose. So the market sentiment is overall bearish as it was in the morning. So broader market is bearish. So industry news, and then he trades Meta. So he looks at the news and he says competitor of Meta facing regulatory challenges, also affecting Meta. So on one hand, the Tesla was the competitor of Meta was facing some challenges, and it was positive for Tesla. But here, the news is affecting in such a way that it's also the news is related to Meta, but it's also affecting Meta. So he said, okay, there is another reason for Meta to go down. Then there's another news comes out, and analysts downgrade Meta. So okay, another negative news. So overall, you know, things are not looking good, and somebody downgraded Meta. So when he looks at the Meta is trading, gapping down from Friday close. Friday was very bullish, and today the market opened and it looks like the Meta will gap down. So trading volume, he analyzed the trading volume, and trading volume at open significantly higher than average volume. So the relative volume of Meta, are you not looking at the screen? Sorry, I am not sharing my screen. This is my problem. I stopped sharing I forgot to share my screen. Okay, so here it is again. Tesla. So I'm sorry about that. So here's the slide on Tesla. So I was talking to you about Tesla complex cause effect. So let me repeat quickly. So Tesla on the run. John actively trade Tesla, right? He see the spike in the price of Tesla. Earning report comes out. Expectation is Tesla beats the expectation. So it looks bullish. Market sentiment is bullish. So okay, market sentiment bullish. Tesla is also moving up. So everything looking good. Then there is a news comes out in Tesla, benefiting Tesla. So news is related to the competitor and it's benefiting Tesla. So that's another bullish. Then he reads another news, analyst upgrades. A lot of firms upgraded Tesla. So it's good. The trading volume is high, so it's also good. So when he puts 2 plus 2 together, comprehensive analysis of Tesla, and based on his previous experience in trading Tesla in the market, he goes long in Tesla and he's making money in Tesla. So this is the way the complex cause and effect coming into play. So he analyzed all the complex causes affecting Tesla price. So this works out to be good, right? So now think about this. So not only he's analyzing the Tesla, all the causes and effect, he is also analyzing himself, how he is feeling. So seeing the signal, so see the signal and recognize that it's familiar. So see the signal and recognize that it's familiar, right? Based on all his previous experience trading Tesla and all this kind of causes. He has seen the causes before, and he knows how the Tesla moves. So he goes and go along in the Tesla. So he recognizes familiar and he feel good about it inside, and then he takes action. So there's a process, there's a mental state in taking action. So he take that action. So what mental state? So think about it. What kind of a mental state you have when you pushing that buy button or sell button? So what kind of a mental state do you have, and what goes on why you have that mental state. So think about that. So now, um, the so I was telling you about the complex cause effect. So there is a linear. So there are many cause and effect scenario. There is a linear cause and effect where Tesla beats the earning and is going up, so I go buy it. So there is a linear just one reason. Thinks the trader thinks just one reason. Tesla going up because it beat the earning. Though there are so many other reasons, and even though the stock beats the earning, it tanks. So what happened? Why? So there's a complex cause and effect. So there's no one reason for the trader to assign for an effect. So this is called linear cause and effect. I'm talking to you about the complex cause and effect, which happens every day. There is a personal cause and effect. There's something called external cause and effect. There's something called magical cause and effect. So I will explain to you all these cause and effect in a different presentation. Magical cause effect, personal cause effect, external cause effect, complex cause and effect, linear cause and effect, and other kinds of cause effect. There is something called correlation, which is not a cause, it's correlation. So something is moving because of this, not it's because of the cause. So right now I'm teaching you about the complex cause and effect because it happened. So I created these slides quickly today, and I'm teaching you. So challenging to identify a single direct cause for an effect. So it's very challenging to identify one single reason. If you, the naive trader just only look for the single cause. He doesn't think in terms of system. So that's why system thinking is very important. Think of it as an open system, so many variables affecting in the market. So that's why when we are trading, we need to be very focused and think in open terms. What else is going on which I am not aware of? Whereas the just one trader, he just opened his app, he just buys it and hope that things will work out. So there are multiple interconnected factors coming together, like it happened today. So it's futile to think in terms of linear thinking that there is only one reason for this to happen. If there's only one reason, the war broke out and the market should go down, and I should go to cash or buy puts. So there's only one reason he's thinking. He's thinking in terms of one reason, where the multiple factors going on, complex. So market is very complex, beyond imagination, beyond um, one person's control. So, so this is the scenario I was telling you. War in the Middle East. So, war in the Middle East. News and events are coming out. So the traders all around the world. Think about it. The trillions of dollars are moving in the market, and here you are with your $5,000 account, or $10,000 account, even $50,000, even $1 million account cannot affect the market. So think about it. Trillions of dollars in the market. So think about all the people in the world, the rich families, the sovereign funds, all the hedge funds, the pension funds, all the experts out there, how they were analyzing during the weekend the effect of this market, how they prepared. Whereas you are just, maybe you were going in a dinner or on the in a movie or sitting on the beach, and then you come on the Monday morning and you say, okay, let's see what is going on in the market. So think about it, how you are perceiving the market and how the experts during the weekend, where the trillions of dollars are under their affecting them or belongs to them, and they are picking up the phone and responding to the news and event. Think about that, whether positively or negatively. So I'm sure they made a lot of a big boy. They made a lot of money today. So recognizing causal link between news and potential market um, event. Now think about three people, or let me see, three people left the webinar. So think how they are thinking. They left the webinar because they saw me not sharing uh, my slides were not moving. So they just left. They are looking for some tips. So they left. One is Priya, another one is David Adam, and the third one is Julie uh, Parmentier. So see how they reacted just now by not seeing the slide. They just left, whereas all of you are still here. So That's the way these three people react in the market also, or everyday life. They just react like that. They just left. So good for them. So now I'm telling you about the scenario of Meta. So same trader John. He wakes up. He knows that the war in the Middle East is going on. So he's actively monitoring the development. Future market looks very bad. So Dow Jones down 300 points and S&P this much and all that. So he expect that, okay, now I'm gonna lose a lot of money. Everything was fine on Friday. Now everything is going to hell on the weekend. So price direction gap down. So we know the gap down. So he says, oh, everything will gap down. Market sentiment is really bearish. Industry news. So he watched Meta. So he read the news that not only the war in the Middle East broke, but the market is bearish. For the broader market is bearish, and the competitor of Meta facing some regulatory challenges. So it's also affecting Meta. So it's not affecting positively, it's affecting Meta. So he says, okay. Then he read another news analyst downgrade Meta. Oh my goodness. Then when the market opened, he see the relative volume, and the relative volume of the Meta is very high. So this also tells him that the Meta will go down, and he um, either buys the puts, or the Meta he has, he sells it. And what happened? Meta, after 1 or 2 or 3 points down, immediately turn upward and starts to rise sharply. So start to rise sharply from 309 to 310, 311, 12, 13, 14, 15, 16, 17, 18, 19, 20, 320. So you see all the multiple complex cause and effect. What he decided about Tesla comes out to be another reason, because they are so, the beauty lies in the eyes of beholder. So the big boys, they saw the Meta at fair value, where whatever they saw, 309, 310. So think about that, the complex cause and effect, and how it's affecting Meta. So that's what happened today. So now, um, if John recognized this, that this is happening, he will see the signal that the Meta has hit some support level, and he recognized the signal. So what kind of signal um, he is looking at? In Tesla, he was looking at the breakout. Uh, Everything was positive, and the Tesla is moving up. So he was looking the signal as a breakout. Now in the Meta, he is seeing the signal as a breakout reversal. So I will explain to you what is breakout reversal. So he saw the Meta reversing to the downside to some support level, right? And then he see the signal. So he recognized that this is a reversal, and I have seen that reversal so many times in my life. So he recognized that it's familiar. So he feel good about it, and he start buying shares in Meta. So today I piled up in Meta, and others I sold. I sold. Uh, so the way I traded these basket of stocks, so I bought Apple, Airbnb, what else? Uh, Meta, Amazon, Tesla. So all this 100, and then I started to close out all the others position. They were not moving, but the Meta is the one which was from the early morning. It showed the bullish sign. So piled up on Meta and close it near the um, market, 12 o'clock, around 12 o'clock. So felt good about it and took action. So bold and courageous action, pile up, and buy little by little, and then buy other basket of a stock and recognize that which one is not working, which one is not working. So take some losses here, there, 200 here, 300 there, 400 there, uh, profit in Tesla, profit in Apple, profit in Airbnb, and then pile up in Meta. So take action. So this is the breakout reversal. So I'll explain to you what is breakout reversal. So now I explained to you, I just prepared this slide today, just half an hour before you came. So there are two kinds of traders, you can say two kind of people. So there's a deliberate and slow thinker. So there's one kind of person who is deliberate and slow thinker. And then there is another kind of thinker who is witty and quick. So there is a witty and quick thinker, and then there is a deliberate and slow thinker. So both are both are both are okay. So deliberate and slow thinker, and witty and quick. And then there is a balance. So people say be balanced. So there's somewhere in the middle. You need to be in balance. So I'll explain to you what is deliberate and slow thinker, and what is witty and quick thinker, and what is in the middle. So deliberate and slow thinker, as named. So he's deliberate. He's thinking slowly. He's very thoughtful. He is steady in his or her resolve. And the negative thing is he's rigid. So he's adamant and rigid. And he painfully slow to change his mind. So very slow to change mind. So when seeing the meta going down, even though seeing it in front that the meta is reversing, um, he is not changing his mind that I need to buy some meta, some options, some some short-term options, or a 30-day out, or buy shares. So he's painfully slow to change his mind, and he's not. He sees the stock moving in the direction, and he just doesn't take the take the action. So he's slow. Now there's another kind of trader or another kind of person. So just think about another kind of person in general. So another kind of person is witty and quick thinker. So these are the kind of person who are witty. They you know um, they say something quickly. Sometimes they say something which is not good. Quickness of tongue. They make the rash decisions, and they jump to conclusions quickly. So the witty. So there's another kind of person called witty and quick. So we are talking about deliberate and slow thinker, and then there is another one called witty and quick thinker. So, and then there are two kinds of traders. One is risk averse, and then there is a risk taker. So risk averse, if we think of risk averse, these are the people who are deliberate and quick, deliberate and slow thinker. So they play safe. They play safe. So they don't recognize. They are very they may not take the breakout reversal trade. That's what I'm trying to say. They have their own trading style. They are not quick in recognizing the breakout reversals. So they're different. Now the risk taker is competent, intelligent, and skilled. So I'm not saying that the risk averse is not competent, intelligent, and skilled, but the risk taker, I'm just saying risk taker, he has developed the skills, and he is willing to take the risk. So willing to take the risk, and it also come from. So I read the books. It says that it comes from the gene also. So it's also from the gene that the risk averse and risk taker. I have seen it in my life. People like when I was coming to America, I explained everything to my friends, and they don't want to come to America. They say, no, I have everything in life. Okay, good. Well, I was a risk taker, so I came to America. So risk taker. So maybe it was in my genes. And then when I look at back, I saw my father migrated from one country to another to another. So maybe I got this from my father. So I'm just explaining to you, maybe the taking risk is in your gene. So risk taking is good if you develop the competency, intelligence, and skill somewhere. So now back to complex cause and effect. So think about the market. Market is very dynamic. Like today, what happened. So we cannot oversimplify that the market is, the war broke out, so I just sell everything, or I look for the puts position. Maybe you found something in put, but today was the day where the things were moving after the initial down moves, things were moving to the upside. So apply the technical analysis, apply the fundamental. Fundamental did not change overnight. So just because the war broke out somewhere, the fundamentals change related to whatever it was for Apple, Meta, um, things like that. So it comes from learning. You can learn, apply the back testing. You have done your analysis before, and when you see the scenario, you see this result. So you see the scenario and you see this result. So and then another thing is that psychologically you're prepared. So you're prepared because you have done so much that you're seeing in front of you the market is tanking, but there are certain stocks which are moving down, and now they are reversing. So you're adopting flexibility. So there's so many things going on in the world, in the world of trading, and traders, they just think in terms of linear cause effect, that if the war broke out, then I must sell everything, or I must look for the opportunity to short. So here's a quick example. Sometime I explain this in detail. Today I'll explain to you in quickly. So here is a market life cycle. So this market life cycle, you can put this chart on a weekly time frame, or you can put this chart on a daily time frame. You can put this chart on a tick chart. So you can go as low as the tick chart. So this is, you can see it could be a tick chart, it could be a 5-minute chart, it could be an hourly chart, it's daily, monthly, weekly, whatever it is. So there is a market life cycle. So today a lot of stocks, the name I gave you, so Apple, Amazon, uh, Tesla, especially Meta, they were doing something like that. So recognizing there is a market life cycle. So in the market life cycle, the philosophy, let's assume this is a daily chart or a weekly chart. So let's assume there's a long term, this is something long term. So in the market life cycle, everything has a, this, like, the Shakespeare said, the 7 stages of a man. So market have a, just like 7 stages of a man in Shakespeare's. So 7 stages of a market life cycle. So just think of 7 stages. So I explained to you quickly what is 7 stages, and each stage we can dissect into in detail, like go all the way to the tick chart. So each stage you can dissect all the way to the tick chart and read it correctly. So the initial phase one, which is here in red, and this is phase one, the market is in a downtrend. So market is just in a downtrend. Think about it, the market is in a downtrend, and I depicted it in a red color. So there's a severe decline going on. And it so happened after a few days or after a few weeks, that market subside. So the volume gets, the the selling volume gets absorbed by the buy. So there's the deep pocket, they start to accumulate that market, that is stock, whatever it is. So accumulation starts, and so all the selling is getting absorbed. So here is a stage two. All the selling is happening, but it's very minor. So whatever is selling happening, the market is not, is going down. So after the stage two, when it subsides, so in the stage two, the market, what it does, it makes a lower nearby low, but the low, the market makes a low, and then somebody comes in and support that low. So market makes a low, and then somebody comes and support that low. So you can see in the candlesticks, if you're looking at the daily chart or weekly chart, you can see the wicks are forming, the lower wicks forms on the candle. So there's something going on. So you see, damn, it doesn't want to go down. And then it's in stage three, which comes after stage two. In the stage three, the market starts to close higher. So it goes down, but it closes higher. So some buying start to happen. So if you have a deep money and you want to participate in stage three, good for you. But the real money is made in stage four or stage one. So the real money in the cycle is made in a stage four. So as a trader, as a retail trader, if, for all, the most money is made recognizing the stage four, when the breakout reverse. So there are a lot of things are happening in the stage four. The market is gapping up, the market has a news catalyst, gap up, consolidation break, breakout reversal, the resistance break, or support touch, and then reversal. So many things, so many phases in stage four. So multiple gap. The stage four could be a long, it could be as 2 year, 3 year, or it could be short as 2 week, 3 weeks. So in stage four, you can dissect. So if in future I'll show you can dissect the stage four, multiple stages of stage four. So stage four has multiple stages. So dip, all the pullback rally, dip rally, and all that phenomena, the gap up, then another gap, then another gap, and all the pullbacks are being bought, etc. So all of the stuff is going on in stage four. The weekly chart starts to look very strong. The monthly chart is strong, and the day chart have all the support, and this, things are looking really good. So if you only want to buy, go long, then look for the stocks which have a strong weekly chart. So look for the strong weekly chart, and then you're looking for the pullback on a daily, and then you or on a hourly or 2 hourly, whatever is your method, and you go long. So this is the stage 4. Now the stage 5, the market life cycle, the stage 5 comes in where the market is overbought. So we call it overbought market. So stage 2 and stage 3 was oversold market. Stage 5 is the overbought market. So the in think of it, the market has entered into some kind of a penthouse. So you imagine the elevator you take one. So you go to a hotel or some building, and they say, okay, this elevator goes only 1 to 100, and then you say, okay, I need to go to the 110th floor. So how do I go to 110? So there is an elevator at 100th floor. You take this elevator, and then you go there, and then you go to another elevator. So think about it. You're going to the penthouse. So the penthouse. So this elevator goes all the way to 100th floor, and then the market is. Let's assume. So I'm just giving you analogy that the stage 5 is like a penthouse. So you're entering in the penthouse. So penthouse is right there, and then the market just collapses. So after the penthouse, there's nothing there. But the retail traders, they get caught in stage 5. They are chasing the market. They chase market chase, keep chasing, and then they get caught at the top. So this is where all the retail traders, where the shade dark green. So all the retail traders, the big boys, they have a lot of resources. The big boy, they are selling to you. So the selling is in a stage 6, which is very it looks minor. So the way it looks like they're quietly selling it. So think about it. The Warren Buffett, if he tells his deputy or someone big fund, they don't announce that I'm going to sell. They just sell 100 shares. So it looks retail. It's very easy to sell in a dark pool or sell 100 shares, 100 here, 100 there, 100. By the time they realize they sold like 500,000 shares today, and then tomorrow 500,000, or another day 500,000. By the time they're done, they're holding of 5 million shares, and you think is just pullback. It's just a pullback. So the retail trader, they are buying on a pullback. And then what happened? All this entries from 3, 4, and 5, there are multiple entries criteria to go long. But when all hell break loose, then there is only one exit, and then the stage 1 begins. So stage 1 begin, everything start to crash, and then the stage 7. So stage 7 is doesn't look like stage 2 and 3. So there is another stage which this time is not 2 or 3. It doesn't look like 2 or 3. So 2 or 3 was a V-shaped recovery. Now the stage 7 is not a V-shaped recovery. It's just long. Just market goes in a sideways motion, and it just kills everybody. So sometimes the market makes phase 2 or 3, like that V-shaped recovery. Sometimes the market makes 7. So we need to recognize where we are in the market. So after explaining to you this, I show you the bottom. So what's happening in the bottom reversal signal? So this is a generic chart. There's no price on this chart. There is no indicator here. There is no volume here. There's no candlestick. So there's nothing here. This is just a bar. I'm just explaining to you trying to explain the complex cause and effect. So it could be a complex cause and effect. And if we just relate it as a linear, so if we just relate one reason, and we ignore all the other reasons, we may get clobbered. So reversal signals, let's say the market is in downturn. So this market is going down, and it looks like it's going down. And then you spot the reversal signal here, denoted by the arrow. So you spot the reversal signal. So if you have a short position, you will, and you spot this reversal signal, you think market is putting on the bottom, you would close your short position, but you may not enter a long position. So you just think, okay, this is a reversal signal, and I need to close my short position. Or you may not have a short position, so you put this stock on your watch list. So you put the stock on the watch list, and you draw the line. So if this is a reversal signal, then you will draw the line at the low, and you will draw the line at the high of this bar. So somewhere you will draw the high of this bar a little higher, and then lower than this bar. and you will draw the line. So now you created a channel. So and then you just put this symbol on your watch list. Now the stock makes another low. So when it makes another low, so now you will get alerted. So you get alerted that the low is broken, and then you see it. But then when you do the analysis, it's just the stock is not crashing down. It's not something that you need to go short it. You just say, okay, it made another low nearby. So you recognize it that it's just minor low is fine. So you draw another low. And then you draw another high somewhere on this bar, and this high is also maintained, or maybe you take the mid section of this bar and you draw another line. So you have two three lines in terms of high, because you need to be alerted when the high of this bar is broken, when the high of this bar is broken, and when the mid section of this bar is broken. So you draw like three lines, and then another one is when the low is broken. So when the next day when the low is broken, is little minor, and it market closes higher. So not only you got the alert on the low broke, and then you got the alert on the high. So you say, okay, this high is made, but it has not crossed the midpoint of this candle. So your analysis saying that when the midpoint of this bar crosses, then I will go long. So that is your analysis. So it's fine. So it depends on what kind of bar it is and why you are deciding the midpoint. So this bar makes a high, but it didn't cross the midpoint. So you set another high here and a low here. This time it broke another low, but then it crossed above. So then you say, okay, now it's trading in a range. So it's trading in a range. You have this feeling that this is a reversal signal, and all this ping pong fashion happening, the market is going in a consolidation. So you keep on putting on the high, the low. This time there is no low, no new low. It's a higher low. So this is a good sign. Now this bar is almost the high. So you say, okay, this is still fine. It has not crossed the midpoint of this bar. Now this bar crosses the midpoint. So you initiate a position. So you may initiate a position. You feel good about it. Whatever is your signal, maybe this bar has some other indicators lined up, not only the bar, but some other indicators which you trust, and the volume and the news. Maybe there is some positive news. So the market is putting on 4 days of a sideway move, and this is the first bar. So you initiate a little bit. So you say, okay, I buy 100 shares, and you initiate, and then the market breaks out, and the market keeps going up and up. So by recognizing that this is the reversal signal, you put it on the watch list, and it took 4 days or maybe 4 weeks or 4 hours or 4 minutes or whatever it is for you to confirm that this market is a breakout. So this is one process of bottom reversal. Now another one, so the same chart, this is a fail trade to the long side, and uh, fail trade to the long side. I will explain to the volume. So I will. There's another presentation on the volume. So I will. It's a good question. I will explain to you about the volume. What else you need to see, just besides price. What's the volume relationship? So there is another separate presentation. I will announce it, and maybe in a week or so I'll teach. So reversal signal. So here is a reversal signal. So just in a downtrend. So this is another one, the downtrend, and you spot this as a reversal signal. It could be a doji, it could be a hammer, it could be another, whatever way of you to decide that this is indeed a reversal signal. So you spot this as a reversal signal. So you say, okay, fine, and then you do the same analysis, same process. You draw the line, and this time the next day the market gapped up. So maybe you went long on this bar because it crossed. So your analysis says, okay, this was a hammer, and the market gapped up. So the hammer created here. This is a low. And the market next day, you were looking for a double confirmation. So double confirmation came in the form of a gap up. So there was a hammer here. So just imagine this candle as a hammer, and so this is the first. Let's say the first um, uh, signal you were looking for, reversal. So you say, okay, reversal, hammer. I close my long short position, and I'm looking for the signal to go long. So the market gapped up. Market gapped up. So it's a confirmation that this market wants to go up. So you went long. So you initiate with 100 shares. Now for 2 days, the market went sideways, but it did not break the low of this. So you're still fine. You're holding it. You say, okay, I'm still fine because it's trading above the low. Now on this day, this bar, the market moved up further. So now you have more confirmation. So you bought another 100 shares. Let's say you bought another. So now you have 200 shares. But then the market reverses to the downside. So your stop loss, your market should not break this low. The market should not break the low of the reversal signal. So when the market breaks the low, this trade is no longer, it's a failed long trade. So it's you need to close your long position here, because if the reversal signal came here and there was a higher low, 3 days of higher low, 4 days of higher low, then this low should not have happened. So this breakdown, so this is the breakdown. So this phenomena is also called as a breakout reversal. So breakout reversal, I will explain to you more. So this breakout was happening and then it reversed. So not only you will close your short position, but you need to take some bold action in going short to initiate a short position. So this is a failed long trade, and then on the downside is continuation of a downward trend. So now this one is a V-shaped reversal signal. So now let's assume this trade going down. So it's downtrending, and the reversal signal, you spot this reversal signal. It could be a doji in the form of doji. And when you look on the left side, there's a support here on the left side. Previously, the market has turned around at the same price level. So you recognize that this is a strong support level. The market has turned around many times at this level. So you say, okay, um, I recognize this is a reversal signal. So if you're short, you would close this position. And if you don't have any short, you would just put it on your watch list. So combining this reversal signal with some kind of a breakout here, you would go long. So combining this is just a candle, this is as a bar, and then some indicators, combining it with the indicators, combining it with the volume search, you will the volume should be picking up. The volume should be down here. So the volume should be down in this bar. So when the reversal signal is coming and the market is making you, if you're looking at the volume bar, the volume should be low and the volume should be high here. So here in the previous chart, the volume should be up more higher and the volume should be lower here in this consolidation range. So volume should be, so later I'll explain more. The volume should be subsiding here and the volume should be very low. So if you analyze the volume bar down here, it should be low bars, below average volume. So if the market trades at 1 million shares, it's trading at 500, 600, the volume is low. Whereas on the uptick, on the up bars, the volume should be picking up in these bars. So the volume histogram should be going up. So, so volume analysis play a role, not only just the price analysis, the volume. So where is the volume? So the volume, so in this bar, which the reversal signal, maybe the volume was still low. So if you fail to analyze the volume at this bar, so the volume was low here, but the volume was low on this bar here also. So when the volume was low and you went long, you see this result. And then the volume picked up. The volume picked up at this bar. And the volume really picked up at this bar. So analyzing the volume with the price is very important. So there are anomalies in the market. So the volume validate the price action and the volume creates anomaly. So this this up bar, maybe the volume was low, so there was this up bar was an anomaly, whereas the volume was picking up here and in this bar, so the volume is validating the down move. So the volume, so pay attention to the volume. Volume is creating anomaly, or volume is validating the move. So pay attention to the volume. So it's very important. So here the volume is the volume is low, and then the volume is low, but the volume start to pick up. So when you analyze, and then when you're looking at the intraday level, like the 30-minute or 60-minute or 15-minute, the volume you should see the volume picking up. So that's why the V-shaped recovery. So pay attention to the volume. Now, if we reverse if we reverse that those charts, then we get the top reversal signal. So similarly, you just reverse it. So it's like this is stock is going up. So it's going up, and then suddenly it gapped up. So it gapped up, but then you realize that this gapped up, maybe it was a gapped up in the penthouse. So like overbought level. So you already recognize that this is overbought level. The stock gapped up. The volume is low. The volume was low, but the price may be high. So if the stock moved up like 2-3 points, and when you look at the volume was low. So the volume low, so nobody was buying it. So nobody was buying it, just some retail traders bought it and moved it up. So you recognize that, okay, this may be reversal signal. So the reversal signal may be this is a twinkle, twinkle, little star kind of bar, or maybe it was a reversal bar. So it made a high. Well, I don't know what kind of bar it is, right? So you don't know what kind of bar. Maybe the high was made here and this was the low. The high was made here, this was the low. Maybe this was just a one little bar compared to other bars. Maybe the volume was low here. Maybe this was a large bar with the price extended. So it's 4 or 5 points, but the volume was low. So whatever is your criteria for detecting that this is the reversal signal, now you put it on your watch list. So if you are long, you would exit from this long position. And then even though the stock is going up next 3-4 days, it's trading in a penthouse zone. So it's trying to break out from level, but it's not. So this reached stage 5 and stage 6 of the market life cycle. And then you keep drawing the low of this. You drew the low of this and then the high. So high broke. So you recognize it. You're patient. So when the high is, so what the traders um, make mistake, and all of us make mistake, is when we recognize this reversal signal and we close the long position, and then when it breaks, goes make a high, we jump back in. So we close at 100, let's say we went long at 85 and we close at 100, and then we go long at 103. So we created another position. So why did you close at 100 and then went long at 103? You must have a very solid reason to go long at 103 when you close at 100. So you must have a reason. So the market goes a little bit higher. So it's doing phase 5 and 6, and then it crashes. So it crashes, and then it just, I don't know where it stops. So the reversal signal came here at this bar, but and then market start to crash later, maybe 4 days, maybe but just 4 bars. So it could be 15-minute bar, it could be a weekly bar, but the market eventually tanked. So you recognize the reversal signal here. Now look at the another scenario of signal. So you recognize that this is a reversal signal. So same, just opposite of. So you say, okay, I'm gonna go short. So you went short on this bar. So you went short on this bar because it broke the low here. It broke the low here. So you went short on this bar. But then, so if you go short on this bar and you're happy, you drew the line here. First of all, if you go short on this bar after recognizing that this is a reversal bar and you go short here, the market should never go in this zone. If it's going in back in the zone, it means the sellers are being absorbed by the buyers. So if this is the market should not go back after breaking away from the reversal zone. The market should not go back in the reversal zone. If it's going back in the reversal zone, it means the sentiment is changing again and the market is about to take off or crash. So if you recognize that this is a reversal bar, then all this zone, the high to low, if you draw the line of the low all the way here and draw the line high, this is the zone where neutral zone, you can say a neutral zone where the buyers and sellers will fight. So Imagine if you bought it at the high, or the traders who bought at the high, or those who missed selling at the high of this bar. So if they missed out selling at the high of this bar or somewhere during this day, assume that this was the reversal bar, and there are a lot of traders who missed out, or big boys, they missed out. Somebody missed out. So they have the sell program. They have the sell program to sell on this when the market starts to move back into this zone. So they bought it somewhere here in this zone. They don't care to sell back at the high. They will sell just in the middle. They will be happy to sell in the middle of this zone. So this zone is a battleground. So this zone is a battleground, and the market, after breaking away from this bar or this zone, the market should never come back in this zone. So the market tried to go back in this zone. So this was first sign that the market, why the market tried. But you said, okay, no, after the market, the buyers and seller fought in this zone, and then the market break away, I'm going to go short, so it's okay. But then the market again go back into this zone. So when the market is going back in this zone, this is a breakout reversal happening. So the market broke out and then it reversed. So this is a breakout reversal. So this is very powerful. So pay attention to when the market breaks away, breaks some support level or breaks some resistance level, and then it does the opposite. So that is the breakout reversal, so, or breakdown reversal. So this is a breakdown reversal. So the market broke down from this, and then it reverses. So when it reverses, so you have to close your short position and then join on the long side, because there is a psychology. All the all the sellers are gone in this bar. The sellers are gone in this bar. When the market close at the high, close a little bit higher, above this level here, right here, all the sellers are gone. And then you should see the volume picking up. So the volume should be picking up here. The volume is kind of neutral. So the volume is neutral. The buyers and sellers, they are fighting, and eventually the second attempt, the volume picks up, and then the volume takes off, and the volume takes off, and the price takes off. So this is a breakout. So this is where you need to think about this chart. This could be a weekly chart, it could be a day chart, and it could be as low as the tick chart. So if you can master the tick charts, a lot of money can be made intraday. So if you can master the tick chart, a lot of money can be made intraday, because you're looking for some kind of breakout and the result comes immediately. The result is right there intraday. By the time market is closed, the market is just taking off. So this is what, let's assume this is a meta chart. So the meta chart, so let's assume, let me think about the example. So Meta uh, um, opened, I think, at 312 or 311 somewhere, and then it made a low of 309, and then it started to pick up. So it went up. It did like this, up and down, up and down, and up and down, and then it hit some 320 level, and then it came down, and then it started to go back in the zone of 316 and 317. So when the meta was trading in 316 and 317 today, it was trading in the it went even to 315 after going to 320. So 315, then 316, 317, 315, 316, 17. So it just kept on doing, and then when it broke, so I started drawing the line. I started drawing the line all day long. So 317, 317.40 was my one of the lines. So when it broke 317.14, I started adding fast to the meta, and then I sold it at 320. 319.85, I sold everything. So this is a breakout. So my meta is going a lot higher. So you would see meta going a lot higher. Meta is going a lot higher. So this one is a reversal signal, V-shaped reversal. Again, just like bottom V reversal, this is the V-shaped reversal to the downside. So let's say this is a stock which is going up. So this stock is trending up, and you are in a long position, and suddenly it gapped up. It gapped up, and the volume, you analyze, the volume is low. So pay attention to the volume. The volume is low. So you recognize that, okay, and then you say, okay, this not only the volume is low, but there's a lot of other things are going in the market. The market overall is bearish. Let's say the war broke out. There's a stock gapped up. There was some news. So you doing the complex analysis. So there's just not one variable. You say, okay, it gapped up, and I'm going long. So no, gapped up, pay attention to the volume, pay attention to what else is going on in the market, pay attention to how long this market is moving up. So if you analyze it, this stock is going up for forever, and here you are trying to initiate a long position at the top. So you don't do that. You draw the line low and the high, and you just put it on your watch list. So it broke the low right here. So you say, okay, it broke the low high. So you can, if you this is actually, this bar is an aggressive entry to short, because if you go short, initiate a little short position in this bar. So your stop loss is right above here, is above the reversal, provided that you know that this reversal signal is a genuine reversal signal. So you put your stop somewhere here. So when you initiate a long position, just a little bit, short position here a little bit, then it broke. So you add more, then you're adding more, you're adding more. So you're adding more to each bar. And your initial stop, which was here, is way somewhere here. Because once the stock is trading in this bar, it shouldn't trade in this zone. When the stock broke away from this zone, it should not come in this zone. And then when it trading here, it should not come in this zone. So you uh, stacked up, scaled in. So this is reversal signal worked out really fast. So now I will explain to you the breakout reversal, which is very powerful. So breakout, what is breakout reversal? Breakout reversal is combining two. So whenever you combine two or three kind of a situation, it becomes more powerful. So when you combine some indicator with the candlesticks, or combine the indicator and the volume, combine the chart pattern with the volume, and all the two, three things together, even or two, three patterns together, combination, that's what become powerful. So you combine the two essential concepts in technical analysis, which is a breakout and reversal. So I explained to you the breakout and the reversal. So breakout and reversal. So in this example, I'm not buying anything. I don't know where is the buy. I would initiate a short position here a little bit, because I don't know what this is just. Um, so it depends. Now, so I'm answering a question. So not only when you analyzing the candle, you're just not analyzing a candle in a solo. So don't analyze a bar in solo. You have to analyze the full landscape. So analyze the full landscape. Combine that bar with the other bar, the previous bar and the bar which is happening next day or next week. So this bar, if this is a doji bar, if this is a doji, let's say, or a reversal bar, and and then this is a gap down. So combining these three may create an evening star pattern. So this becomes an evening star pattern. So evening star pattern, combining these three, I put a high stop above the high here, and this gap down, this combining these three may become an evening star pattern. So this is the short position, not the long. So I was explaining to you about the breakout reversal. So breakout reversal, combining the breakout and the reversal. So breakout could be above the resistance level, and then the stock, so the stock is trying to break the resistance, and it breaks the resistance, so it's called breakout. It broke the resistance, and then sudden move next day or the intraday below the resistance level. So, or the stock broke the support intraday and it goes down, and then it starts to move above the support. So that is a breakout reversal also. So combine the two concepts of a technical analysis, the breakout and reversal. And on top of that, so you're not only analyzing the chart, and not on top of that, you're analyzing the volume and analyzing you may have some indicators and your overall expertise, your skill, what else you're seeing it. So that's why I said the complex cause and effect, not just linear cause and effect. So the breakout scenario could be that the stock move beyond support or resistance. So it could be, if it's a bullish, let's say a bullish scenario, the stock is breaking above the resistance level. So there was some resistance level, you watching it, and it's just bumping up resistance level, and is just hitting, and then it breaks it. So there's a shift in the market sentiment. So the stock moves bumping the resistance, and then it breaks the resistance. So there's a shift in the market sentiment. There's no longer selling at the resistance. It's continuation of a trend. So it's a continuation of a trend. So this is the breakout scenario I'm talking about. Or to the downside also. So think about it. It could be a downside or it could be upside. So now, what kind of a signal? So you're looking for the signal. So you need to write in your trading plan, you need to write your signal, what you're looking at. So you're looking at what? You're looking at some key price levels. So think about it. You say, okay, I'm looking at some key price levels. These are my price levels. So you draw the line, horizontal line, vertical line. You may be using the trend line break. So you say, okay, this is my trend line. This is a weekly chart. This is a trend line. This is a upward sloping trend line, and this is a horizontal support trend line, or this is a horizontal resistance line. So you're drawing all those trend lines, resistance line, support line, maybe on the weekly chart, maybe on the hourly chart. You have your support levels, and then on top of that, you combine it with your candlestick or whatever bar, whether you use open, low, high bar, or candlesticks bar, or there's other kinds of charts. Whatever is your method, you're using it to identify that this is a signal I'm generating. And not only that, then you're seeing that diagram I showed you. I'll show you in the next slide. So the breakout is confirmed by the volume. So look at the volume, and you are confirming it that is the volume had picked up. The breakout is also confirmed by time. So don't forget about the time, that it took a while. So it took like 2 hours for Meta to just keep trading between 315 and 317, 315 and 317. It took like 2 hours. So when it takes 2 hours for the stock to just go up and down and up and down, and suddenly it just breaks up, and so it must be a powerful break. So volume picked up, time 2 hours. So you take a bold and courageous action. So this is where you have to be bold. So you have to have some kind of a mental state where you remind yourself that I need to take some action, seeing the glass half full, not seeing the glass half empty. So that kind of scenario. And then you're feeling in your tummy. So think about it, feeling in the tummy that is good. You're feeling something good, trading action in the direction of breakout. So you take the action in the direction of breakout. So how would you, if you put it into a simple, this this chart I'm showing you, I got it from Rhonda Byrne CD called The Secret, or the movie she created. So go and on Amazon or on Audible, somewhere on YouTube, watch that movie, The Secret, or buy the CD, 4 CD sets, The Secret. And in The Secret, this is described, this scenario described. So I'm just giving you in simple words. So if you just get that 4 set CD by Rhonda Byrne. So you see the signal and you recognize as familiar. So you have to, for every trading scenario, you have to go through this. See the signal, you recognize as familiar, you feel good about it, you take action. This is applicable in any endeavor. So I give you another example. So let's say I'm driving by, and I'm not in a hurry to buy a house. Let's say I'm not in a hurry to buy a house. I'm not in the market to buy the house, but I am driving by, and then one night, so I have a habit of taking different direction, different road, just to see what is out there in the real estate. If somebody is selling something, and I see the sign open house tomorrow, and the house looks really good, and I feel good. I recognize it's familiar. I have seen it, so I go in the back alley or I go on the side, and I look at the other house, and I go on Zillow immediately at the midnight, and I'm evaluating, and I see that it's really, this property is really good. And then I attend the the open house, and I confirm myself that this is really good. So I need to take a bold action. I need to put my offer right in. And then what happened after 2, 3 days? I called the seller's agent and then said, okay, we have accepted the offer and all that. And then all the other homes in that area are still sitting 3 months gone by because they did not give you this feel good about it. So same way, if you don't feel good about it, you need to get out of that trade. So if you feel good about it, take action. Even if you feel good about it and you took action and you're not feeling good about it, you feel something is going on in your inside, you close that trade. So now I'm talking to you about the reversal definition. So what is reversal? So reversal is, so then we will combine the breakout with the reversal. So change in the prevailing trend direction. So it's obvious what the definition of the stock is going up and is turning to the downside, or the stock is going down, is trending to the upside. So that is the reversal definition. Now, the signal. So now you need to have a different methods of reversal signal. So signal may be generated through technical indicators, signal may be generated through candlestick patterns, signal may be generated through price and volume anomaly. So the signal may be generated by the way the price action happened during the day. So whatever is your method, you recognize that this is a reversal signal. So once you recognize the reversal signal, you're not acting right away in a haphazard way. So you can go through the deliberate and slow method process. You remind yourself that, okay, I can be deliberate and slow, but when the time comes for me to make the decision, I'll become witty and quick. So I'll become very quick in taking the decision. So what is the reversal trading action? So bullish reversal, you will go long. So just general reversal, you will go long. If it's a bearish reversal, you will go short. So this is just an example. So and now I will give you the breakout example and then the reversal, and then combine it into breakout and reversal. So what is your breakout example? So objective, application, and risk management and time frame. So think about that. What is your objective? So objective is to capture the trading opportunity when price breaks out of a significant level. So what is your significant level? You need to define it. So no, reverses is direction. So this word, you take out this word, reverses direction is not. So breaks out of a significant level. So break out a significant level, not the reverses direction. Application, combine indicators. So you may have indicator like MACD, RSI, stochastic, whatever it is. You're combining it with the volume. So the volume is picking up. You may be using Fibonacci levels. So you read somewhere that the certain Fibonacci levels, 38, 62% or 50% act well, and it has retraced 50%, and the volume is picking up and it's rising above the support. So I am going long or breaking the resistance level. So whatever is your method of going long, you do that, and then whatever method is your for risk management. So you may put the stop below the low, recent low, or recent high, whatever is your method of identifying that, what it will tell you that you are wrong. And this process you can apply to any time frame. It could be as low as a tick chart, and it could be as high as a day chart, weekly chart, or day chart, and intraday hourly chart for swing trading. And for intraday trading, you can go into the 3-minute chart, 5-minute chart, or even a tick chart. So go as low as tick chart, or go as high as a daily chart and hourly chart for swing trading. So this is your objective for a breakout. You monitoring it, a certain break, either above the resistance or below the support, and you're combining it with some indicator, you're combining it with the volume, you're also using the Fibonacci levels or some retracement levels, and you are confirming it with the price action, and then you're feeling good about it, and then you recognize it's familiar and you're feeling good about it, and then you are taking action. So that is a breakout example. Okay, so that was I messed up. I prepared the chart and I recognize the messed up here. This is a bullish breakout. What I'm saying, top trading in a range bound pattern with clear. Yeah, so this is a bullish breakout. That was a reversal. So I messed up in my slide quickly. I prepared few slides today to teach you in a hurry. So it's basically it's the same. So this is what I explained to you in the breakout, what I was explaining you to do previously, that clear support and resistance. So identify clear support and resistance, and when So for the breakout, you're monitoring the resistance level. So some kind of a resistance level. So not all resistance break of not all break of resistance are worthy of your trade. So think about the resistance level, analyze it in terms of price, analyze it in terms of how much time it took, analyze in terms of its strength, the volume. So previously, if the resistance level was built with the heavy volume previously, then it needs a heavy volume to break that resistance. So that resistance becomes strong when it was built at a heavy volume compared to the resistance level built at a low volume. So think about it. If the resistance level is made up with a heavy volume, then there are a lot of sellers there. So a lot of sellers sitting there, and now it's breaking that resistance level. So a lot of those sellers are getting absorbed by the buyers. So the stock breaks resistance with a strong volume. So the trader enter a long position anticipating a bullish breakout. So this is a bullish breakout, and that was a reversal slide. So again, the same scenario. So you need to uh, apply this method, and the method is same. See the signal. So seeing the signal has a lot of component behind it. So you're seeing a lot of things: the resistance level, the volume, the Fibonacci level, the indicators, the market news, the gap down, the analyst upgrades. You're seeing a lot of things, and then you're putting it all together and saying, okay, I recognize this familiar. I gave you example of a Tesla, and I gave you the example of Meta. So I gave you example, and then you say, okay, it's familiar. You feel good about it, and then you take action. So everywhere, whether you take a bullish action, whether you take a bearish, whether you take a bullish breakout, whether you take a bearish breakout, you are applying the same process. So in between, there is a bad scenario situation, which I did not include, and you can turn it around and make it a bad scenario. So this is a good scenario. You see a signal, you recognize familiar, you feel good about it, you take action. Now, in between, you can insert another scenario where you visualize a bad scenario. You say, okay, what if I take this trade and it turns out to be a loser? So you start to feel remorse already, which is not had happened, and you're already seeing somehow you in your brain or image, you're creating a negative scenario. So when you create a negative scenario, you bypass, you just don't take action, and then you just go into a vicious loop of analyzing all the negative scenarios. Every time you see a trade, you recognize, but you visualize a negative scenario, bad scenario, and you don't take action, and then you become sloppy. Eventually you become sloppy and then you give up and you say, okay, next time when I see the trade, I will take it. And that's the trade where you were not feeling good, but you took it because all day long you have been feeling bad and ignoring all the trades and which are working out. So now you see a trade which is not good and you're not feeling good, but you take the trade, and that's the trade which become a loser trade. So think about it. You can create a good scenario or you can create a bad scenario. So what is a bearish breakout reversal? So I explain, let's see what is bearish breakout. So objective is the stock trading in a range bound pattern. So the stock, so I'm describing a bearish breakout reversal. So the stock is trading in a range bound pattern. So think about it, it's trading at a range bound with a clear support and resistance. So you draw the line of support and you draw the line of a resistance. So now you start to monitor. So trader monitors as it approaches resistance level, looking for a breakout. So let's say the stock is moving up and you're monitoring it and it's hitting the resistance level. So you just say, okay, it's hitting the resistance level and I'm monitoring it for a breakout. Now the breakout, the stock breaks resistance, but with the mild volume. So you see, you the stock breaks the resistance with a mild volume, and then the news comes, the bearish news comes out. So when the bearish news comes out, the reversal stock reverses below resistance. So the stock broke the resistance level, but with the mild volume. And then the negative news comes. So when the stock breaks the resistance level, the volume was low, and then the bearish news comes. So when the bearish news comes, the stock comes below the resistance level. So let's say the stock was trading at 100 and the resistance was 101, and the stock breaks the 101 with the low volume, and then the news comes out. and it's a negative news. So it breaks the 100, and then you can, then you take a short position, and it's called bearish reversal. Because what happened, it broke the resistance level, and then it comes down below the resistance, and then it starts to just crash. So this is called a bearish reversal. So bearish reversal is when the resistance breaks and then it comes down, and a bullish reversal is when the stock breaks the support and then moves up. So again, it's the same scenario. Every time when you take a trade, you remind yourself that I'm seeing the signal and is familiar. So you're comparing the chart or all the things which are put in front of you. You're comparing the scenario, you're analyzing it comprehensively, and you say, okay, it's familiar. I have seen it before and I must take action, and I'm feeling good about it and I must take action. So you take action, or you can create a scenario visualizing all the bad scenarios, that how much money you will lose when you take this trade, and eventually you will take the trade which was not supposed to be taken, and then you lose in that trade. So this ends the today's session on the spotting the reversal signal. So let me go back. I show you these charts. So here's the reversal signal. Reversal signal came, the market went on the sideway mode. The market went on a sideway mode. The volume, you're analyzing the volume is low, and then the volume picked up. When the volume picked up, you recognize that this is a reversal signal, and volume picked up, you take the bullish um, trade. Here, the reversal signal came, and the market, you're watching it, the volume is low, and then when the breakout bar happens, the volume is still low. So you try to remember the volume is still low. This breakout volume, this breakout bar is not a valid bar. It's not getting supported by the volume. So this is anomaly. So you're waiting for the breakdown. Now this bar, this is a reversal signal. This reversal signal came, and sometimes the stock just do the intraday. So most of the time, this pattern is appearing intraday level. So in intraday, if you're watching it intraday, this pattern is occurring in a lot of trades. So prepare your baskets of all these Momo stocks. Start with Apple and ends with Tesla. So in between there are many. Starts with Apple, Amazon, Adobe, Intu, Crowd, Cyber, Baba, Baidu. So there are like 13 horsemen. There are 13 horsemen, the big boys. So they move a team. So there's another one team. So they all move. So spot the intraday reversal. So this is the intraday reversal bar, and the volume picked up. Now this is a reversal to the downside. So the reversal you spotted here, and the stock goes in the penthouse, it's doing its thing, and then eventually it crashes. But you spotted it here, and you waited patiently. In this bar, you spotted the reversal here, but then the this it broke here in this bar, and then it went into this zone. So when it goes back, the market does not have any reason. If you are short and the market is going back into the previous reversal zone, then your short is about to lose money. So you need to be prepared to close your trade. The moment you spot um, the the stock is coming back in the reversal zone and the volume is picking up, your short is not going to work. So close your short and join the other side of the market. Join the other side of the market. And the last one is a V-shaped downfall. This is the reversal bar. When you combine the three bars, it may be evening star pattern. It depends what this bar has done, what this bar is, whether it's a gap up bar or the key reversal day or whatever. So you combine it into three, and then this bar is telling you that this reversal signal was genuine reversal, and you go short. So these are the three reversals to the top side and three on the downside, and then you combine the breakout and reversal, which becomes powerful, whether it's a breakdown reversal or a breakout reversal. All right, so I'll see you maybe on Thursday. I'll teach another topic. Thank you. Bye.